But my next guest sees the index heading higher ultimately into year end. Let's bring in macro risk advisors, John Kolovos. John, it's great to catch up with you here. I mean, we're, S&P bleeding lower here, down about 0.8%. And there was some excitement when we got that breakout above 6,800. It seemed pretty emphatic. Where does this leave us as we just kind of give back some of those recent gains?
Hey, Mike, good to see you again. I think ultimately, until we break the October lows, even the 50-day moving average was a little bit above there. I know yesterday and even today is a little bit, scary. We got some volatility coming in. Ultimately, I think we still need to thread the needle to at least 7,000 by early next year, and if not a bit higher into 26, perhaps as high as 7,500 to 76.
The market is sort of trying to get away with one of these rotations away from danger. You have the mega caps that are really making the indexes look worse, and the majority of stocks trying to hang in there. Is that something you think is sustainable? I mean, under what circumstances do we see a market change character like that?
Right. I think what's uncanny of the last couple of years is how the market structure has changed so much, right? It's been very concentrated. What did we have earlier this week? We had one of the worst breadth days on an up day, right? That used to never happen prior to like 2020. Now it seems to happen more often than not. So if you're talking about breadth and concentration and the narrowness of the market, my take is that if you think the market is going to expand and see breadth and participation to continue, I think that's a pipe dream. I don't think that's going to happen anytime soon. I don't think it happens until after the next cyclical bear market, to be quite frank.
Yeah, I mean, and that would be sort of the way it goes, right? I mean, everyone kind of points back to when, small caps and the average stock did really well coming out of the crash in early 2000s, and that's because the mega caps got destroyed mostly. What about semis in particular? Because obviously they're a key leadership group. You have a lot of this fundamental tailwinds, but, the semi index has started to look a little extended.
Yeah, so on the semis, definitely overbought, right? 35% above its 200-day moving average is overbought. A little over 90% of stocks above their 200-day moving average, that's overbought. In recent history, that's been good enough for a 7 to 10% decline. It even marked that big wallop we got in 24, which from memory was about a 35 to 40% drawdown, right? That's been recent history. But you have to ask yourself, where are we in this cycle? If you think that semis are in a bubble and they're going to continue to go, 35% above the 200-day moving average isn't that overbought. If you look at those metrics during the late 90s, it was good enough for like a pullback. Of course, yes, I'm mindful of that, but it didn't peak until it was 100% above its 200-day moving average, right? So mindful of the overboughtness of things, sure, but I think it's too early to say that its bubble has peaked.
Yeah, I was going to say, I think kind of open-minded about how wild things could get. You never know if they will, but how they could get. You mentioned you think that the market can still work its way towards 7,000 on the S&P. What is, I guess, the general cycle and pattern work tell you about next year? We were just having a conversation. Sometimes you get a strong finish to a year and then maybe a little bit of a reset and a rethink.
Yeah, that's one of those things. So we all know that end of year, you're supposed to have strength, right? We're in like the best 3 months, et cetera, when we get into November. November's an awesome month historically. But my worry is for next year as we go into a midterm election year, that is a year when equity markets tend to either go through a major correction, if not some sort of cyclical bear market. So you have above average odds of a huge shakeout next year. So what does that mean? That means we have to we're getting pretty darn close to some sort of important top in the equity market. So as I'm threading the needle to at least 7,000, maybe we overshoot that. I want to be looking for in that first part of the year whether or not we're actually doing a proper top in the equity market to follow that seasonal pattern. I'm more worried about the longer term cycles for next year more so than what this year is trying to tell us. So, and I ultimately, I just want to go back to the breadth thing real quick, Mike. It's like those, like the small caps, you got to keep a close eye on it, right? I think a lot of folks are thinking that we're going to get help from the Fed. We haven't gotten help from the Fed, from the real economy stocks. Breadth has been abysmal within small caps. Small caps are at new highs. The AD line is making almost new lows with it. So that's very, very important. So interest rates, I think, are going to be very, very key and could very well lead us into a mini 2018 if we see the 10-year get above that 420 level, if not a little bit higher. So very, very important.